Good afternoon, I'm Brigid Taylor and this is Currency Wars. Joining me in the trenches today is RMB's Anthony Grant and Andre Cilliers, he's the director at TreasuryOne. But let's first take a look at what's driving the currencies around the world. For now, the Eurozone seems to be stabilising, with the first round of reform measures passing comfortably through the Greek Parliament. This opens the doors for the Germans and other members of the Eurozone to vote on the same reforms in order to pave the way for Greece's third bailout. However, the International Monetary Fund has thrown a spanner in the works for a Greek bailout, and it says that it's unlikely to assist the Hellenic Union until such time as creditors come to terms with the need to write down some of their Greek debts. Meanwhile, in the US, a strengthening US economy and waning risks from Greece and China are keeping the Fed on track for a rate increase later this year. The Fed Chair Janet Yellen, in her testimony yesterday to Congress, again emphasized that the timing of the first rate rise is less important than the subsequent path of increases, which she said would be a lot more gradual than the market had expected. But the forecast issued by the Monetary Policy Open Committee in June implied that 2 quarter-point rate rises will be followed by a shallower path of increases this year. Meanwhile, in South Africa, the Reserve Bank has a dilemma on its hands when it holds its Monetary Policy Committee next week. It has an inflation problem, with consumer price inflation expected to head to 6% and above by the end of this year. But the economy remains weak and fragile. The bank remains a reluctant hiker and as such is expected to keep rates on hold once again in the meeting next week. Meanwhile, the rand remains under pressure, and this is despite Greece's crisis being averted. The currency remains on a weaker bias and is well supported around 12.32. Right, now that we've seen the lay of the land, I'd like to welcome Anthony Grant from RMB and Andre Cilliers from TreasuryOne. Thank you so much again, guys. So things have calmed down. I mean, we've seen the Greek crisis being averted. The banks aren't open yet in Greece, so I think that that's something that we'll have to keep an eye on. That will give us impetus as to whether or not these negotiations are in fact going forward. Just give us an idea, Anthony, I'm going to open with you, your view around the currency and how it's trading right now. I mean, it's carrying, that level of around 109, 110, which in my mind speaks to optimism around the Eurozone. How do you feel about that?
So I think everybody has to realize that the problem's far from over. So I think the immediate risks and the immediate concern of a fallout are over. And the Greece issue, the contagion effect is a lot lower than it was a while ago. So I think, the impact on the currency is probably less than it could have been. The immediate concerns now is how does Europe get that bridge loan in place? How do they fund the most immediate needs? And then put a proper deal on the table? Because like you said, I think the IMF believes that their debt in the long term is completely unsustainable. So, even with another bailout, is Greece ever really going to get out of this? So, I still think there's lots of, talks and lots of risk to come. But the immediate thing is how do we get that bridge financing in place to meet the 20 July deadline?
Well, I think you're right, and I think that one of the interesting things that has come out of this whole Greek crisis has been the fact that people spoke about just getting rid of Greece. It's a burden, it's not necessary for the Eurozone, it's not necessary in terms of the cohesion of the zone. However, the fight that went on, if we look at the comments out of Germany, out of France particularly, supporting keeping the Eurozone as the entity that we know and understand. So does this speak to more protection and better emphasis in terms of managing the debt levels in the weaker states? And how do you see that playing out in the next couple of weeks ahead?
Now look, this whole debacle has certainly showed up some cracks in the euro. But I think from a euro side, they are trying their utmost best to show unification. I think that's why they're trying to keep the Greeks in the euro and not outside the euro. Going forward, I think what we will see is those cracks dissipating a little bit and being mended. And there will be support for other states as well if necessary, and there will be a unification, a unified stance from the Eurozone.
I agree, and I think that, like you said, I mean, if they don't unify that state, because the only thing that really keeps them together is the fact that they share a common currency. However, they all have their own fiscal policies. Monetary policy, because of that, is a game that's, it's played very carefully between the stronger states and the weaker states. So it's going to be interesting to see how the Eurozone actually does pan out with regards to it gaining back those debt levels, getting those budget deficits down. But let's move to the US. So, and we saw Janet Yellen yesterday. I mean, she got lambasted by the Finance Committee, talking about the independence of the FOMC, etc. But more importantly, she did reiterate the support for potential interest rate hikes. So what is your view around the interest rate environment with regards to the US and then that caveat that we have in South Africa?
So I do think most economists are saying September will be the time to rise. I think obviously Yellen can't specifically give any direction on that. So the two key indicators that she continues to look at is wage growth and inflation towards 2%. Now, wage inflation has probably been sort of low and sort of scarily low because jobs are growing, but the wage inflation isn't growing. So she'll probably continue to look at those two variables before making a proper decision. But I do think she will hike in September again, or she will hike in September, and that puts pressure on us to probably also look at increasing our rates.
Well, that's the thing. I mean, it puts the rand under pressure because we see this continued weakness in the rand with regards to the fact that our MPC is behind the curve. I mean, we know that the economy is weak and we know that growth is weak. However, we were talking offset and just saying how much of that interest rate potential hike is going to really impact that. So just talk us through your views, Andre, with regards to the negative impacts of an interest rate hike versus the positive impacts.
I think there's more of a positive impact on an interest rate increase. It shows the independence of the South African Reserve Bank and underlines that, which is from an investor point of view very, very important. I think it also places positiveness on the side of local investors into the economy that things are on the right track still. If we can then see from an Eskom side that there's improvement, etc., then we'll start seeing growth coming back into the economy. But an interest rate increase is certainly not going to damper interest rate growth in the economy. You can even lower interest rates by 1/4 percentage point, and it will not substantiate anything in growth-wise.
And we do need to support the currency. I mean, as we said earlier, if we're behind this curve, if Yellen's talking about these, even if they're very gradual, so they do 2 more increases, that's quite significant in terms of that interest rate gap that we start to see with regards to the risk that you're putting into South Africa as a growth engine, and with our inflation sitting at potentially 6% by the end of the year, on top of which you've got a better return with lower risk and better growth coming out of the US. So that does pose a risk on the currency. So just talk us through quickly, and just to end off with the South African scenario, we've got a couple of issues at play. The growth issues, if we look at China and we look at South Africa as a commodity-based currency, is taking a bit of flack. I mean, you look at Canada, you look at Aussie, they're in the same boat because of what's happening in China. Just give us a quick view in terms of what your risks are around the Chinese fallout that we're currently seeing.
So we see China as a much bigger risk than what's going on around Greece, the potential for that. So the news coming out of China now around export growth and GDP of around 7% sounds positive, but I think if you hit the nail on the head, if you look at copper prices, they are at an all-time low kind of thing, and they will continue to go down. And China being that big consumer just shows you what activity is happening there. So I think global growth and emerging markets in specific, are at risk for China. I do think, with the Chinese government trying to prop up the stock market and putting measures in place, it's probably a long-term play, but it's certainly a risk we're going to have to watch a lot more carefully. Over and above that, there's not a lot of positive news in South Africa. If you look at if you look at consumer spending and you look at sort of the PMI type data, so I think Andre is right. Investor sentiment is all we've got to go on. We need to show credible measures of managing the economy, and that's why the interest rates probably
probably the biggest speaker. Okay, so we're going to move on to your views for the week, and now that we know where we stand, we are going to look at pulling out the big guns. Right, guys, so this is it. I want you to talk predominantly about the euro and the rand, obviously. Give me some of your views on the rand, but going into MPC next week, and obviously with this China issue on the back burner, what are the risks that we should be watching out for? So I think, because the market's been so volatile, just give our viewers some idea of things that we can watch out for that give us that preemptive move that we can expect. Ant, I'm going to start with you.
So there appears to be a bit of a risk-on scenario at the moment. The guys are looking for good news, so that is positive for the rand. If we get a rate increase next week, that'll also be positive for the rand. So like you said, we've got to break through 1232 to get down into the 1220s, which could be possible. At the moment, it's bouncing in a range 1237 to 1250, unfortunately.
Okay, and Andre?
Euro rand, 1355, 1375, quite close. dollar rand, I would call it 12.25, 12.50. Also very close, with a bias to sort of trade in the middle of those ranges. And I quickly want to add one comment. When you get to interest rate decisions, it should be not defensive, but managing a process. If you wait with an interest rate increase in South Africa, you will be on the defensive and not managing.
And you don't think we're there already?
I think we are there already, and I still put my money on an interest rate increase because I think the Reserve Bank is firm out there in managing the process and not trying to defend something.
Thank you. Thank you very much for your views this week. So, you know, just to sign off for the week, I'm going to just give you the views in a nutshell. We are looking at that 12.32 level as a significant level on the rand. If it breaks through, both Anthony and Andre see us trading down to potentially 12.20, 12.25, but watch the ranges because there is a lot of uncertainty in the market right now. The rand does remain, however, on that weaker bias. If you're looking at the euro rand, narrow trading just because of the Greek debacle being put on the back burner, so you're looking at about 13.55 to 13.75. However, if you'd like to send any questions or comments, you are more than welcome to do so at CNBC #CurrencyWars410 or to myself at KGAN Capital for your personal responses to the FX markets. Until next week, good luck in the trenches.